Hello everyone, I'm Marko, Kangraga, Head of Quant Research for the Americas at RavenPack, and this Chat with the Expert series will discuss news analytics in the new ESG investment paradigm. My guests today are Nathan Cockrell and Pierre. Nathan is a Managing Director at Lazard Asset Management. He's also the Co-Director of Global Research for Lazard Discretionary Equity Strategies based in London, and serves as a research analyst primarily covering the global consumer discretionary sectors. Lazard has a significant quantitative investment practice based in Boston and London, with ESG being an area of focus where discretionary quantitative teams work closely together. And Pierre is the head of ESG at CFM, a Paris-based quant fund. He had previously launched Prius Partners, a fintech set to quantify the financial effectiveness of ESG integration based on ESG momentum and materiality. Now, our conversation today will focus on the emerging trends in ESG investing and how these news analytics can enable investors to track, measure, and monitor ESG news in order to better navigate the emerging ESG wave. Gentlemen, welcome.
Hi, Nathan.
You're welcome.
So we can start with kind of a general discussion. We'll cover a few of the points. Perhaps Pierre can cover a few topics that he deems extraordinarily important in this ongoing ESG wave. Pierre.
Right. We're very happy to do that. Thanks, everybody, for attending. I should say first about CFM very briefly, and that's on slide 3. We are about 260 people. 2/3 of us are really working in IT and research, actually probably 3/4. And we're managing above 7 billion today. So there's also the next slide that shows some of the links we have with the academic world. We pay a lot of attention to making sure that we stay on top of everything quant, including with the best academia can provide. And maybe to really jump into the topic of today, if you go to the following slide, number 5. I guess the main message is that there could be legitimate questions about what a quantitative systematic hedge fund would be doing with ESG. I mean, of course, we could always say there's room for making sure that we integrate some ethical angle to anything we're doing in any sort of business, but that's not what we're talking about here. That is important, but that's not what is addressed at the moment. What we have found is that those concerns about climate for many years have been mostly addressed through bottom-up research analysts being able to find the gems in the market, to being able to find a few companies, few players, the Tesla, if you want, of sustainability, which had a brilliant future and maybe today are extremely expensive when they're not already bankrupt. So there's a complete change in the sense that instead of trying to be just focusing on those very few opportunities, what we believe makes us very legitimate in the field of sustainability today is the fact that it's climate concerns are now propagating to the entire market. It's really broadening well beyond the few very niche segment that it was essentially a key driver in the past. We see that in many more sectors, in about 2/3 of the market, we start seeing some signal. It's quite weak still, but there's a lot to do based off that, using the quant tools that we've managed to deploy over the last 3 decades. So if you go to slide 6, actually, it gives you an illustration of what I just said in terms of which areas of the market would be for us of potential interest or focus. I should also maybe mention, and that we might discuss that later in the conversation, but that it's very clearly no longer just a matter of trying to identify what's green, what's already on the right side of the EU taxonomy, for instance. But more importantly, especially as there is ambition to shift trillions and to make sure that capital is deployed to make the entire economy, not just a few segments, very green, it means that we need to identify the companies that are best prepared, that have all the necessary capital. It's financial capital, but it's also human capital, which will make them capable of doing this big migration. So it's actually really what's greening, which we need to identify now. The next slide, maybe if I can just, so it's slide 7, give an example of, sort of business as usual for CFM, contrasting it with the following one, which is introducing what's sort of different. As a quant fund, we've always loved to use backtest. And in some dimensions, this climate transition has already started playing out. So for instance, if you look at the direct emissions of companies and some component of what you will find denominated as transition risks, especially when there are measures which directly tie into the current emission intensity levels of companies, there is a way to extract from the current data some signal that actually creates alpha, and that's been creating alpha already for some time. But the following slide is another interesting example we find where we think that even for the sort of information that does not have any interesting track record in the past in terms of aligning with the ability to generate alpha, it's still absolutely key necessary to integrate such information, because it will be very relevant in the future. When we speak about scope 3 emissions, we speak about all the different emissions that any company, because of its activity, is generating through its suppliers upstream and through downstream its clients and up to the final use of the product or service. So you could very find yourself being a company that doesn't have any or much direct emission, but still, imagine there's a carbon tax. You could find yourself very heavily penalized just because your input price would go up quite a lot if your suppliers are able to pass the price increase, or maybe some of them will disappear, and or your clients, the demand side of things could also be quite negatively impacted. So it doesn't necessarily mean that we should integrate it right away. But here comes the very point of today's discussion, I suppose. The question is when and where, in which part of the market do we believe that at some point it will be very important to start integrating such factors. Because here, compared to the usual case in finance, where the conversation is pretty formatted in a very unambiguous narrative. If you are in mainstream finance, if profits are up, it's good. I mean, there's no ambiguity here. ESG, and that's maybe the something that you can see on the following slide 9, is very much a matter of a cacophony of conversations, really, because you have all sorts of stakeholders. It's not just shareholders concerned, now it's stakeholders. So you have the NGOs, you have the government, you have all sorts of industry specialists, consumers, of course, you have blogs, you have, and all that creates a lot of information, some of that gradually becoming material as more and more people in the financial sphere start realizing that at some point regulation will change, that the governments will impose some bans or some taxes, etc. So, to the question, which predictor should we use? It's no longer based on backtest. It has to be based on something more forward-looking, and this is really where following conversations is what we believe holds the key of success. The following slides is just small experiments we made using Bloomberg's news flows. So we just wanted to see for different type of topics, whether or not we would see a pickup in the proportion of the news that were dedicated to those or linked to those topics, and clearly that's the case. And there's a lot that we can find already in terms of relationship between the emergence of a carbon factor and the increase in the relative proportion of environmental related or climate related news in the news flow. And just to finish, the following slide is where you could see some of the fundamental data which we believe that you need to be aware of when you look for what's green, or again, I should say what's greening. Again, it's multidimensional. And I'm even not talking about ESG in general. I'm really focusing on climate change here. So it's the pillars that you find in pretty much every net zero carbon alignment framework, or direct emissions, indirect emission, transition risk, and physical risk. But it's all a matter of, again, when and where for which sector and with which relative weights should we integrate those factors. And this is where we believe that NLP will be very instrumental. We've already accumulated some evidence that there's a way to make the data speak in this way to help us weigh how much we need to integrate those factors in every specific segment. And the last slide, slide 12, is giving you a sense for the relative weights for those various predictors, direct, indirect emissions, physical risk, transition risk, but then also the portion that we dedicate to much closer to the market, where we put our finger on the pulse of the market to eventually counterbalance some of the lagging effect of the fundamental data we use. That's one key theme as well in ESG, as I'm sure everybody is aware now, is that the more fundamental and factual scientific data you find, the more lagging probably it is. And when you need to cover extremely vast universes, you need a way to make sure that you're not missing a more recent part of the action. So that's also contained in this product, and that's also where listening to conversations we believe is key. I'll stop here. Thank you.
Kind of along the lines of the carbon tax that you mentioned, how do we know when that thesis becomes reflected in the price of a stock? When does the market actually start caring and your thesis converges to what you believe the market should be pricing in?
Yeah, well, we'll make the bet that we won't need to wait until we find the proof through a long back test, because by then it would be too late. So for us, it's necessary now to take a view that certain factors, certain fundamental realities at some point will integrate the realm of pure finance. But there are a couple of pointers, a couple of necessary conditions if you want. Let me take the example of biodiversity. Biodiversity is certainly an extremely concerning dimension in all the various environmental challenges that we face. One that some say is actually going to hit us harder and faster and sooner than climate change itself. However, the big problem is that there is no real data set yet. I mean, it's something that starts to be built, but you need to be much more local in the assessments you're making. The same exact company operating in the same manner 10 kilometers away from each other, those two companies will have potentially an extremely different impact. So it's really a data problem. And then you will find that probably for that reason, yes, you hear lots of different types of sources talking about it, NGOs, and there's more and more concern within or all sorts of circles, including regulators, because it's part of the next step in TCFD. But then you don't see much of that topic being mentioned when you look at analysts' recommendations. So this is typically how we would consider that we need to or we have an opportunity to time when to act on certain topics. It's when a number of conditions are met, including having data and finding that they are conversation happening in amongst participants that are directly recommending or making investment decisions. But we can get prepared for that by listening to those conversations before they get into that context.
Great. Maybe this is a good time to take a slight shift. And Nathan, you are in charge of discretionary equity strategies, and you closely work with quants on parsing through some of this data. Can you walk us through how you think about this emerging trend and this new paradigm?
Sure. Well, my opening observation is I think of ESG as a subset of alt data. So this is information which is initially non-financial in its characterization, which does, to varying degrees, impact the valuation of securities. And I think if we look back at 2020 as a whole, look at the impact of COVID, look at the green stimulus packages that have come out of the need to drive economic growth, the importance of ESG has been really clearly demonstrated. So ESG is driving policymakers, it's driving economic allocation decisions, and it's driving share prices. So the question is, how do you parse that old data to help inform your investment decisions? And how do you navigate an increasingly complex taxonomy, a kind of acronym soup of interests and organizations? And how do you work out what's greenwash and what isn't greenwash? So our approach has been to identify initially things that we think pertain to ESG risk, so that we can have a live dashboard for issues and concerns that could cause significantly negative share price outcomes. So that's a kind of initial mindset of managing risk. But we also think ESG generates significant alpha. So companies that have solutions to other companies' problems have valuable future revenue streams. So we've done a lot of work or what we call green revenue analysis, which is identifying a systematic approach to looking at companies that are well positioned and then identifying events and progress within their businesses that point to future growth. So ESG is alt data. ESG implies both risk and reward. It generates alpha. And our view of investor preference is that this is a growing need to separate green and brown, or to identify companies which are getting better. We call it improvers. And we think ESG data, including sentiment analysis from news, gets us out of this kind of horrible, static, backward-looking approach to ESG data and moves us into real time and enables us to connect our long-term investment frameworks to real-time information.
So I mean, maybe this is a good time to also open it up for questions from the audience. And I can start with the first one that kind of is almost a mandatory one in terms of dispelling the ESG myths. And I think it's still certain investors assume that ESG is a form of socially responsible investing, which started decades ago in the form of avoiding investments for moral or ethical reasons, and that it's still primarily a box-checking exercise, or at best a downside mitigation strategy, kind of by avoiding sketchy companies. And while this may have been true at one point, this paradigm is obviously shifting meaningfully. So can you tell us a little more about how you apply these non-financial factors as part of your discretionary process to identify material risks and obviously enhance your returns? And a little bit deeper about how you, for example, think about the S component, which is a little bit more ephemeral than the governance component that investors have perhaps unknowingly been historically using quite a lot.
Sure. So S is a good example of where COVID has kind of demonstrated the rules have changed around how significantly governments and business will change their practices to react to consumer need and societal preference. So in 2020, we saw companies competing to advertise how much value they were giving back to the communities that they supported. We've seen government subsidies to business, enormous government subsidies in terms of employee furlough payments. And any company that thought that it could receive those payments in one hand and give money to shareholders in dividends with the other has discovered that governments are stakeholders in their businesses. So 2020 has clearly demonstrated that the social element of ESG is big and it's relevant. It's also, and I guess this is one of the hardest things about ESG, ESG is a moving target. And the arrival of COVID has demonstrated that a massive global event can change government and business priorities. But even much more recently than that, with the emergence of the controversy around the Xinjiang region of China and the treatment of the Uyghur population, an issue that had been understood in the ESG community for years, I would argue, suddenly became politicized when the US, the EU, and Canada and the UK decided to start imposing sanctions on China, at which point an issue which had been several years in the making suddenly caused front page news, sanctions and disruption to business process. So again, ESG is a moving target. There's a constant interaction between business process and society. Internally, we talk about something called the societal license to operate, which we think is what all businesses essentially rely on to make profits. And we see from time to time big challenges to the societal license to operate. And that's why ESG is hard. That's why you can't take a static approach. You can't just leave an algorithm to run. You have to understand that social preferences and political situation is changing and react to it.
And Pierre, feel free to jump in if you have anything to add, or I can go down the list here.
Yes. No, I very much agree with what Nathan was just talking about. Maybe from our more systematic, rather than discretionary standpoint, we have looked for ways to extract also some alpha signal from S situations. We haven't yet really found that it's possible to really preempt, and be ahead of the curve. Mostly people react to negative news, but prices have moved already. And then quite often we see some mean reversion opportunities more than trying to actually be selling the bad guys before the controversy happens, if you see what I mean. So on the E front, we find that maybe the time frame is much longer. Obviously, things won't happen and then be solved in just a few months, as they sometimes happen on the S front, or when you have a fraud, which is maybe a G sort of signal. And also, as I said, it's probably reverberating through bigger circles of companies, through the entire networks of suppliers, and because it's basic economics, if you want, but potentially with a relatively small impact. So you need to listen to a signal that's potentially quite weak, but that will be persistent and will create a drift for the next few years.
Yeah, that's interesting. So I mentioned a couple of investors have historically already paid a lot of attention to ESG, whether they like to admit or not, by penalizing companies with, let's say, misaligned C-level incentives or questionable accounting practices or general lapses in business ethics, et cetera. Like incentive pay should be aligned with the underlying structure of the business. Board composition should be staggered. Proxy process, so, do you do your own voting or not? But kind of the increasing trend we're seeing is related to solving, like it's mentioned, the emissions problems. But there are longer term, smaller companies that tend not to have very good disclosures, but are likely on the forefront of innovation here. How would you approach identifying these opportunities that are maybe not as well disclosed in the filings?
Yeah, well, it's really I'm sorry, Nathan. Yeah,
no. Go ahead, Pierre. You got the jump on.
Yeah, no, I was going to say you can use a combination of again analyzing supply chain networks, making sure that you don't have your eyes only on the few names that everybody's talking about, the ones that you find in the clean energy baskets, for instance, or just the oil major company, but they are in a web of myriad of companies, public and private, by the way, and being aware of what happens in terms of patent, in terms of commercial flows, in terms of M&A, in terms of hiring, recruiting, is actually getting you to the next layers where maybe the better risk return opportunities exist.
Yeah, on our side, the analysis we've done on green revenue has mostly been about working with existing business activity taxonomies to help identify which are green and which aren't. So we've created a spectrum initially using ARBICS, which is 1,584 industry activity classifications, focusing on which are green and which are brown. And then using quantitative processes, we can parse our investment universe of 12,000 securities and identify which companies have which exposure. And that's really interesting because a lot of oil majors have very significant investments in renewable energy, but they're lost in the output of their carbon heavy fossil fuels activity, but they are still potentially systematically important. The same applies to utility companies and companies which generate energy. So by taking a systematic approach, we can funnel down to a smaller group of investment opportunities. We can build tilted portfolios towards green and brown. We can deliver client outcomes that specifically seek to focus on what we call improvers. And they're a really important group of companies because if you believe in the Paris Accord and the goal of net zero, then you don't want to exclude investment from heavy emitting companies. You want to engage with those companies in the transformation of their business models long term. So one of the things that a lot of our highly engaged and relatively sophisticated ESG clients want us to do is to connect an investment approach to an engagement approach, which is why we're fortunate to be a firm which has quantitative investment expertise and fundamental analysts. We can take an investment preference all the way through to engagement and actually talk to companies about how they change their business models and over what time horizon. So this idea, the kind of archaic idea that ESG was a box ticking exercise, and if it was about anything, it was about exclusions, has really changed as people have understood that achieving net zero is going to need extra investment, collaboration up and down the supply chain, and actually engaging with the heaviest emitters about how they transform their business models. And we think we've developed the tools and dashboard to identify them, and we have the human capital to engage.
Perhaps this is a good segue into the next question. I'm seeing it's related to sources. So there are obviously a variety of sources that you can monitor for this type of information, like from shareholder focused to stakeholders focused corpuses. How do you think about source filtering and what sources carry what weight? Perhaps Pierre.
Well, as I said, we indeed need to extend beyond the usual sources and probably also be capable of classifying sources because we, completely agree with Nathan's point about ESG no longer being a box-ticking exercise. There's certainly always an ethical dimension. I mean, in a way, we've invented ethics to save ourselves long-term without, trying to encapsulate that in short-term formulas. It's not necessarily contradictory. It's used to be in the past because there was, this concept of having to choose between value and values. I mean, clearly now is going the other way. But still, you're not sure when something material would be financially material. And as I try to say, it's really when you see that you have the combination of reliable enough fundamental data that helps people, visualize what companies are doing, and hopefully, as you said before, checking, that what companies are doing is not contradicted, but what they say they're doing, or that there's some consistency. And then you want to monitor all these sources to measure the degree with which some of them actually are making investment decisions, because that's when you go from materiality to financial materiality. At the end of the day, it's a matter of it's a matter of critical mass. Same thing can be said about exclusion. I think there were some studies demonstrating that obviously if you are a very solitary ethical investor, you represent 2-3% of the market. That was responsible investing 30 years ago. When you decide to exclude tobacco or gambling, etc., there was no way you could expect that you'll be rewarded financially, because you do something that would have no impact whatsoever. But when you had the decision by a global compact to rule out tobacco firms in July 2017, it was very interesting because it triggered a movement from all these investors who rely on global compact to give them sort of the indication of what is unacceptable. And because they divested at the same time, they actually benefited financially quite substantially, because there was a very substantial derating of the tobacco company. Some studies were saying maybe if you go to 10% or certainly 20% of investors making the similar decision, maybe not to try to capture financial gain, but just because they act in concert, then they actually create a moving price. So the concept of financial materiality, you see, it's not it's something that you uncover as you follow the news and as you check what people are saying, and if there are critical mass there's a critical mass of investors, so market participants, not just people talking about the topic, but people who talk about the topic that have a vested interest in finance, then you can be pretty sure that you've crossed that line and you moved from materiality to financial materiality.
Yeah, financial materiality is a really important concept. We did something internally involving all of our analysts, both on the equity and the fixed income side, to sit down in sector groups and think about how ESG was financially material to the sectors that they followed. And we created something we called the materiality map. It's similar in its shape to the SASB map, but what we did was do deep dives on what individual issues meant. So if there was an issue, for example, around data security and cyber security, turning it into numbers meant understanding what the size of the fines was, what the size of IT investment on a multi-year basis would look like to protect those companies from that risk, and turn what I call turning words into numbers. And I think that's the biggest challenge around ESG. Is at the moment it's very largely word-based, which is why sentiment analysis and news feeds is so important. It's actually pretty data sparse. Our job as investors is to try to turn that into numbers, even in quote unquote factual areas like carbon emissions. About 60% of emissions data sold by third parties is actually based on estimates, so it's built using proxy tools. So if you compare corporate disclosure with the estimates you can get from third-party vendors, you can quickly realize a lot of it is guessed. So this landscape desperately needs more disclosure, and that's something investors can do, is press companies to disclose the data. But there is going to be a data deluge of extraordinary proportions, and even as by training a discretionary and bottom-up fundamental analyst, I recognize that this is going to be the kind of data problem that only quantitative approaches can solve. I don't think you'll be able to do ESG in the future unless you're a data scientist. There's going to be so much data to pass through.
And if I may jump in here, things are only going to get worse, right? Because I mean, if we had the luxury of time, if we could say, okay, those are issues that, provided we solve them in the next, we start solving them in the next 20 years, we'll be fine. We would probably have done something more logical, which is to first ask a certain number of disclosures from companies. And then once we have the data from companies, we can ask investors to use this information in their investment process. But we don't have time. And regulators know that that's not a luxury scenario we're in. We rather will need to swim, to learn how to swim as we swim. And so pressure is already on investors before the data has become available. So I guess I subscribe to what Nathan is saying here, in the sense that there's going to be even more data, and very difficult to navigate the data. It's going to be all about narratives. I take one example. Is gas green or not? It's actually, we don't know, because the Commission is actually debating whether it's green or not, it obviously makes a big difference, when you position with the view that you want only aligned companies today. So that only, to me, is an illustration of a wider phenomena, which is that compared to traditional finance, where you can expect that within a few quarters, at worst, you'll be vindicated, you'll be right or wrong, you'll be proven right or wrong on the view. When it comes to ESG, it's unfortunately not necessarily the actual reality that is going to decide, in 1 year, 2 years, 3 years, if your view was right or not, but it's whether or not the paradigm shift has happened that you believed would happen. So it's a question of narrative building and monitoring the building of narratives.
Yeah, so the good question there is, in terms of going greener, is, say, nuclear, which has accumulated a lot of stigma, but is perhaps a clear answer to mitigating some of the climate damage that's happened. How do you think that narrative might shift in terms of ESG investing? And is nuclear likely to lose its stigma?
I don't know. I honestly don't know. I mean, as you say, clearly, when you left the conversation about what's green or not, what's environmental friendly or not, to people who were very passionate about it, clearly a country like France, where that more than 75% of our electricity is from nuclear, there's a very clear divide. But probably, as your question you hinted in the way you asked the question, I think that will shift. I mean, that reality will sink in gradually as you have more stakeholders and more people involved into that conversations. Maybe it's a bit of political also, horse riding with the French trying to find an agreement with the Eastern Europeans about accepting gas if nuclear is accepted. I mean, so that's why it's so complicated. Again, it's not just a matter of finance. It's really a matter of many more circles being involved in that discussion. But yeah, probably nuclear will be seen as a necessary option in the mix.
Well, I'm increasingly mindful of your time, and I think that's a great point to end on. Nathan, Pierre, thank you, gentlemen, for joining me. Really appreciate your time, and thanks everyone for attending. If we didn't get to your question, or if you have any comments or suggestions, reach out to us at RavenPack.com.